100 SP for life, why or why not? I've had 100 of my money in SP 500 since I began investing. I am just piling into FNIL except for accounts where that's not available to me, in which case I'm in the lowest X ratio SP 500 fund available. I plan to roll everything into FNIL at retirement. If I have enough in my retirement accounts that I am not worried by a 40 or even 50 downturn, why not be 100 in stocks throughout my retirement? Why sacrifice long-term yield if I can afford to weather market downturns? I do own a home W15-year financing, so stocks are not technically all of my assets. 11 years left on the loan at 1.9. Thank you for any insights. Nothing wrong with it. Just be prepared for 50 market drops for extended periods of multiple years. Pros probably about the best risk-adjusted returns. Diversified. Reinvest of dividends automatically. Cons can't touch your money during market drops which can last years. Unexpected expenses would be problematic. One solution would be keep a higher amount of cash for emergencies. If you can stomach the possible downsides, then that's the argument for buying into riskier investments. You'll beat 90 of the professional investors and probably 99 of amateurs and this is a big if you can stick with it during downturns. I have known people with 401ks in the index fund and they stuck with it when it went down 10, down 20 they're still with it, 30 no problem they bought more, 40, well they got a little bit worried, 50 they sold. Seeing your index fund drop 50 is not an easy thing to take. Most of us assume our future self is a lot more risk-tolerant than they really are. I still contribute to a retirement at this stage in my life, but I run a 85 SPY position along with a 15 cash position. I use the cash position to buy into SPY on downturns. I have a simple rule I adhere to and have outperformed the market the last 9 years. When SPY dips 10 YTD that essentially triggers me to dump 25 of my cash position into SPY. If SPY drops 20 YTD I dump 50 of the remaining after my initial dump when it dropped 10. Hasn't failed me once. That's it. No target date funds, no bonds, no international, nothing. Simple as that. In the long run you'll be great. Don't cry that one morning it drops 20 and that week it drops 40 more. Eventually, it will almost certainly, probably be fine. Eventually. X200B. Interesting to watch people who have been in the market only since 2010 or so. The last decade has not been normal. Because you buy anything that's gone up a lot and use that as your rationale for investing. Sequence risk. See Lost Decade 2000, 2009, 1929, 1943, and 1966, 1982. SP 500 is possibly overvalued compared to small and mid-cap, which is something like 20 of total market weight. Ultimately valuations will revert to cash-generating potential of the underlying businesses, so unless you believe that the largest 500 companies inherently have more revenue growth potential than the rest of the economy, it may make more sense to do a total market fund. Stocks versus fixed income is a different conversation. Just don't pay off the mortgage early. Milk that 1.9 interest rate for all it's worth. There's a lot of advice to diversify with 20 or so international funds. Take that or leave it for whatever it's worth. Yes, you can keep your money in stocks, but as you approach retirement you want to be able to count on the money being there. In 2008 the SP dropped 40. That would not be a good time to retire, but that is when I retired. Fortunately I had half my money in bonds and cash, so I only lost 20. The other lucky thing was that I was so paralyzed with fear that I didn't do anything. So the money in stocks grew dramatically over the next decade. Fun fact: FNIL is mutual fund and it does not track any SP index. It tracks Fidelity in-house index to keep offer the mutual fund at zero fee. Return will be different from SP 500 index. The one thing that concerns me about SP 500 is how concentrated it has become in just a handful of stocks. 30 of it is the top 10 stocks. Almost 10 of it is just Apple. If something happens to the valuations of just a few mega-cap tech stocks, the SP is gonna take a real beating. I personally prefer a total world fund that includes small and mid-cap and also developing foreign and emerging market exposure. Even total world is highly concentrated at the top but not quite as bad. Why? Because 90 of professional fund managers are unable to beat it. No international diversification. 100 bet on SPY is a 100 bet on Eternal Pax America. As with Rome, empires rise and fall. It's better to diversify globally. Warren Buffett suggests 10 cash and 90 SP. 10 for cash needs that you mentioned. Why not QQQ, or a split? If you don't want to invest a lot of time into researching, and even with research how much more will you make? Going all in SP is a valid strategy. If SP has fallen, the world has fallen and you have got bigger problems than just your money. It's a great strategy, as the SP 500 has always recovered from crashes within a few years. However, for that reason, once you're a few years out from retirement, or in retirement, you should really take a big enough chunk to support a few years' worth of expenses, and put that in something safe. The cash drag is worth having that safe harbor to see you through during a crash recovery. As long as you are confident you don't need that money for 20-30 years, I think it's likely that you will earn a higher yield in stocks. Money market funds, CDs, or bonds are less risky the shorter the time frame. From a theoretical standpoint, it isn't diverse enough and we don't know if USA will remain a great stock market. Historically, over a rolling 30-year period starting from July 1993, you would have outperformed international and small cap value on a DCA basis. DCA basis starting from July 1993. SP 500 SPY 9.65 per year. Small cap value 9.57 per year. International blend 4.82 per year. Large cap growth 10.58 per year. Most definitely. It has been my approach and worked extremely well for me over the last almost 40 years. The longest bear market since 1940 is 2 years before the market hit a new high. That's happened 4 times. As long as you can ride out 2-3 years of a downturn, odds are in your favor that you'll be fine. For retirement, my plan is to keep 3 years of annual spending in cash bonds. The rest will continue to be in index funds focused on the SP 500, tech, and healthcare. SP 500 is extremely overvalued right now and will see poor returns over the next decade. Small cap value, REITs, and international stocks will provide better returns moving forward. Well, it's not a bad thing to do. But a portfolio of 13 SP 500, 13 US small cap value, and 13 long-term treasuries has given basically the same return with dramatically lower risk since the 70s. It's not defensive at all. So if you wind up in the drawdown phase, and there's a big extended crash or recession, you'll wind up cannibalizing your portfolio by selling shares. The same applies on the eve of retirement, hence the classic shift toward more fixed income going into retirement. What's an index worth if it's dominated by a handful of non-diversified companies? No, because choosing some stocks leads to underperforming. That's why I have 100 total world stock market. Because a 3-fund portfolio growth, stability, broad market will outperform the SP. Also, because the SP had basically just turned into another tech portfolio over the years. Why not all world and chill? Just because SP 500 performed better in the past few years means nothing for the future. Brother, hate to say this, but your investment are at risk of having a greatest loss if the American economy fall and took some long time to recover. Never ever invest everything all on a single basket, even if it has the greatest companies to invest with. You must be able to buy some assets individually and other for basketed investment ETF and mutual funds to be the best.